Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 160, titled Comparing Implied Volatility and Delta when Establishing Projected Trading Ranges During Our Options Contracts. We're going to be using a real-life example with Nike Inc., which trades on the New York Stock Exchange under the ticker symbol NKE. I'll also be using a few other securities to make our points. So let's start off by talking about what are our strategy goals when we're using implied volatility and delta incorporated into our option selling trades. Well, we're looking to generate weekly or monthly cash flow using an ultra low risk approach, in this case, an 84% probability of success trades. We're looking to establish trading ranges for specific option periods using both implied volatility and delta. And we want to craft our strategies to align with an ultra defensive and capital preservation trading using deep in the money calls, deep out of the money calls, and deep out of the money puts, depending on what our strategy goals are. So with that said, let's get started by defining the term implied volatility, and then we'll define the term delta. Now, implied volatility is a forecast of the stock's price movement as implied by the options pricing in the marketplace. So the thing that a lot of investors don't know and understand about implied volatility, that number one, it's based on one standard deviation. And what that means is the trading range that is established with this IV statistic is expected to be accurate 68% of the time. So that's something that has to be factored into our trading decisions. Now, the second thing is that these IV stats are typically expressed in annualized terms. So for example, if a stock is said to have a 35% implied volatility, that means that it's expected to move up or down 35% over the course of the next 1 year. And if we're trading a monthly option, that does not mean that over the next month, the security is expected to move up or down by 35%. So as a result, we need to use a conversion factor or a spreadsheet that will give us the expected implied volatility for a specific options contract time frame. And I'll be giving you that formula, and I'll be discussing a spreadsheet developed by the blue collar investor that can be used specifically for this. Now, since 16% of the data points in one standard deviation will fall above the range, and 16% will fall below the range, the probability of success then is 84%. The 68% that is established by one standard deviation, and then if we're looking for the low end of the range, well, those that supersede the range by 16% on the high end are still okay. So it's going to be fall out of the range, depending on our strategy, only 16% of the time. That's what creates an 84% probability of success with these trades. So in other words, when we're using these trades, then there's only a 16% chance of the price ending below or above that range. Now, again, this isn't a precise number. It's a likely number. So it's an approximation. So I want everybody to understand that this is a probability, 84% probability of success trade. That's how I'd like to frame it. So we defined implied volatility. Let's now define the term delta. Now, delta does have multiple definitions, but the one that applies to this particular presentation is the probability of an option expiring in the money or with intrinsic value, right? So if we sell an out of the money put and we don't want that put exercised. We don't want the option expiring in the money and bringing us to the point where we either have to buy back the option or accept the shares. Same thing if we're doing portfolio overwriting and we don't want our shares sold. So we want to make sure that that option that was sold, that deep out of the money call option, is not expiring in the money or with intrinsic value. So in order to compare apples to apples with implied volatility, we're going to use deltas of 16%. Once again, creating an 84% probability of success trade. Now, we're going to be using real life examples in this podcast, as I stated earlier, with Nike Inc., but we're also going to show results using IV and Delta for Etsy Inc., Invesco QQQ Trust, Vanek Vectors ETF, and PayPal Holdings. So those tickers are ETSY, QQQ, SMH, and PYPL. Those of you who are also watching this podcast, you will see it in graphic representation coming up soon. Let's first use the BCI expected price movement calculator. And those of you who have access to a pen and paper, I'll be giving you the actual formula, the conversion formula, in just a few seconds. But with the expected price movement calculator that was developed by BCI, on the top of the spreadsheet in the white cells, you're going to enter the following 5 statistics. First, the ticker symbol, NKE in this case, the date of the calculation, and I created this screenshot on 8/30/21, the expiration date of the options contract, which was 10/1/21, so about a monthly expiration. The price of Nike at the time was 167.57, and the at the money implied volatility 31.81%. That's all you do. Just enter those 5 things into the white cells at the top, and here's what the spreadsheet will calculate for us. The number of calendar days to expiration, if taken to expiration, 32 in this case. The expected trading range using the conversion formula, which I'll give you in a second, is $15.78. So based on this 32-day trade, Nike is expected to move up or down by $15.78, and that's based on the options pricing in the market at the time that this information was entered into the spreadsheet, which will give us an expected trading range of 150-179, and the upper end would be 183.35. So if we were selling, for an example, an out of the money put or an in the money call, we would seek that 150-179 low end of the range, which would be accurate 84% of the time. If we were portfolio overwriting and we didn't want our shares exercised and assigned and sold, we would be looking at that 183.35 upper end of the trading range, which would be accurate 84% of the time. Okay, pen and paper if you want to take down the formula. Here's how you do it. If you have access to this spreadsheet, which all premium members of BCI does have, just go to the member site on the right side, resources download section, scroll down to E for expected price movement calculator. Now, here's the formula. What you do is take the price of the stock, multiply it by the at the money implied volatility. Here's the tricky part now. Multiply that by the square root of the number of days to expiration divided by 365. Now, I know that seems complicated to a lot of you. So if you just write it down and then use your calculator, you will come up with a number that will tell you how far above the current market value and below the market value that stock is expected to move in this specific time frame to contract expiration with an accuracy of 84%. Once again, if you're a premium member of the Blue Collar Investor, you don't have to write this down. Just access the spreadsheet and use the spreadsheet. It's very simple to use. Now, if we looked at a Nike option chain, because we just showed you the results using the implied volatility. To compare apples to apples, we'll use a 16 delta strike, which means an 84% probability of success or not expiring with intrinsic value or in the money. With Nike trading at 167.57, the option chain at that point in time showed us that the 150 deep out of the money put had a delta of 16. Of course, deltas for puts are negative because they're inversely related to the price of the stock. And you could see here that generated a bid price of $1.36. We would probably negotiate a better price since the ask price was $2.10. But that said, the 150 strike is what we would have in mind. Now, what I did was I wanted to compare the ranges created by implied volatility. Those of you watching this podcast would be right in the middle where I have my cursor now, and then compared to the delta ranges on the right side of this screenshot. For those of you not watching, I could tell you this, that the both approaches will work. Okay, IV and delta will work. They will give you extremely high probability of success trades. But what it shows is that the ranges established by delta are wider and therefore safer. However, one of the things that should be obvious and to everybody is that not all options will have deltas precisely at 16. So you may have to go to the closest to 16. And in any case, generally speaking, using delta will, in this small sample here of 5 securities, generally will produce slightly wider ranges. But both of these should work quite well over the long haul. Let's summarize. Using either delta or implied volatility to establish trading ranges specific for options contracts will result in highly accurate results. Now, delta has the advantage of slightly wider and therefore safer ranges, but the premiums might be a little bit lower. And also, not all options will have deltas precisely at 16. So there's always a little give and take here. But the takeaway is that both will work quite well over the long haul. Now, implied volatility will create ranges specific for each and every IV stat. So, it's like the analogy I'm using on the screenshot here is, what do you want for dessert? A banana split or a 7-layer chocolate cake? Either will work well. So, it's splitting hairs to say which is actually better. Okay, ladies and gentlemen, before I go, as I always do on these podcasts, for those of you who want to master the strategies of covered call writing and selling cash secured puts, I want to briefly tell you about our 2 best packages. First, our best and most comprehensive educational product, the BCI package, which is an acronym for that, has 18 components. Component number 18 has over 200 components. It includes 6 online video courses with downloadable workbooks, 6 calculators created by the blue-collar investor, found nowhere else, 5 of our best-selling books in ebook format, and the 18th component, our annual 13-month premium membership, which also includes now very close to 250 training videos, in addition to our eligible stock and ETF reports for option selling, and many other calculator spreadsheets, resources, and ebooks, and so on and so forth. So all that's included in the BCI package. The other of our best packages is the Trade Management Calculator package, which includes a one-of-a-kind TMC calculator, which allows us to enter our trades, get initial calculations, and get this, over 20 different exit strategy adjustments it allows you to make, and then get final post-adjustment trade results along with total portfolio trade results. That comes with a 28-page user guide for the spreadsheet, as well as my 8th book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts in PDF format. You can get more information on these packages going to our website, thebluecollarinvestor.com, and clicking on the link at the top that says Best Discounted Packages. You can also go to the bluecollarinvestor.com store and get these items individually. Ladies and gentlemen, I want to thank you very, very much for taking the time to watch this BCI podcast number 160, comparing implied volatility and delta when establishing projected trading ranges during our options contracts. Folks, I hope you enjoyed this presentation, but more importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.